You ever feel like the investing world is just a constant flood of information? I mean, daily news, market swings, experts saying opposite things that can really make your head spin. How do you actually cut through all that noise? Find some real long-term insight. Well, as we were digging through your sources on long-term investing, one name just kept popping up. Philip Fisher. He's often called the father of modern growth investing. And his book from way back in 1958, Common Stocks and Uncommon Profits, it really changed the game. Back then, Benjamin Graham's value investing was pretty much dominant. Fisher came along with this totally different perspective. I mean, even Warren Buffett, who's famously a Graham guy, said, I am 85% Graham and 15% Fisher. That tells you something right there.
It really does. And that's our mission for this deep dive, isn't it? To really unpack Fisher's, well, uncommon way of looking at companies. We want to explore how he looked way beyond the balance sheets to figure out what truly makes a business great. And crucially, how those ideas, those timeless principles, are still incredibly relevant today. You can actually use them to understand some of the biggest, most successful companies out there right now. We've pulled together insights from your sources to show you exactly how Fisher's thinking connects 1958 to, well, right now.
Okay, so let's get into that. This foundational shift he represented. In Fisher's day, the smart money, so to speak, was all about balance sheets, right? Looking at assets, finding stocks that look cheap compared to their book value. That's the classic Graham approach. Pure numbers.
Exactly. Tangible assets, what you could see and count.
So Fisher, he argued for something completely different. He was diving into the qualitative side of things, the people running the company, their vision, innovation, the culture.
Yes, precisely. He got that the real value wasn't just today's numbers. It was about future potential. And that potential was driven by these, well, less tangible things. It was a huge shift in thinking. Fisher really pioneered this idea of investing in great businesses, not just cheap ones. That sounds normal now, maybe, but it was radical back then. He understood that the really massive investment wins, the home runs, come from spotting companies with that huge long-term growth potential before everyone else does, before it's obvious.
Right, spotting the potential before it hits the mainstream radar.
Exactly. He saw that a company's value wasn't fixed. It was dynamic. It was about what it could become, driven by those qualitative factors, the people, the strategy.
And to actually uncover those factors, he developed this signature strategy. It's got a kind of funny name, the Scuttlebutt method. What's that all about? Where did that term even come from?
Yeah, it sounds a bit old-fashioned, doesn't it? Scuttlebutt. It's basically Fisher's term for doing on-the-ground qualitative research. Think of it like old-school investigative journalism, but for investors. You're actually talking to people in the company's ecosystem, their suppliers, their customers, industry experts, maybe even former employees or people at trade associations.
So getting the real dirt, so to speak.
Kind of, yeah. Or maybe just the real story. The crucial insight, and this is still so powerful today, is that these qualitative details, these conversations, often give you the best clues before anything shows up in the official financial reports. This kind of digging can reveal, how happy customers really are, what the company's reputation for innovation actually is within its industry, how good their operations are, how effective the sales team is. It's about getting behind the curtain.
That sounds incredibly useful. Almost like having a secret weapon. But let's be realistic. In today's world, with everything online, how practical is it for someone like you, listening now, to really do that kind of deep scuttlebutt? Seems like a ton of work.
That's a really important point. It is work. And that's exactly why Fisher thought it provided such an advantage, because most people won't do it. Most investors today, let's be honest, they look at the public financials, maybe read some headlines. Fisher's whole point was that the truly valuable insights, the uncommon profits, often lie in this less accessible qualitative stuff. Now, you might not be flying around interviewing suppliers, okay? But the mindset of Scuttlebutt is still totally relevant.
How so?
It means reading online reviews, but reading them critically, listening to specialized industry podcasts, following niche news sources, even just talking to people you know who use a product or service, asking deeper questions.
So it's about being a detective in your own way, using the tools available now.
Exactly. Looking beyond the spreadsheet for genuine clues about how the business actually works and how it's perceived by the people who matter, customers, employees, partners.
Fascinating. And all this detective work, this scuttlebutt, it feeds directly into Fisher's main framework, doesn't it? His famous 15 points to look for in a common stock.
Yeah.
It's basically his checklist for spotting these truly great growth companies he wanted to hold on to.
That's right, and it's an incredibly thorough list. We probably don't need to go through all 15 right now, but maybe we can highlight a few that really capture his unique perspective.
Yeah, good idea. Which ones really stand out?
Well, for instance, his focus on management's determination to grow sales, that's point 2. For Fisher, this wasn't just about having good leaders. It was about finding an organization deeply committed, culturally committed, to always pushing forward, always evolving.
Okay, so it's about the drive.
Yes. And then there's effective R&D, point 3. Again, not just about having smart people invent things, it was about a continuous, well-funded effort to innovate, to stay ahead, ensuring the company didn't become obsolete.
Makes sense. Long-term survival.
Exactly. And another crucial one, maybe the most crucial for him, was management's integrity and alignment with shareholders. Point 14. This was absolutely non-negotiable for Fisher. These weren't just boxes to tick. For Fisher, these qualities were the very heart of a business's long-term potential, the engine that could drive those compounding returns over decades. He also added a key caveat, though you don't need a perfect score. Companies rarely hit all 15, but you need most of them.
The power of this framework really hits home when you start applying it. Looking through the sources you mentioned, it's almost uncanny how these ideas from, the Eisenhower era perfectly describe some of today's biggest tech giants and successful companies. What were some of the clearest modern examples that jumped out at you?
Oh, the connections are striking. Let's take Apple. You can just see Fisher nodding along. It's a perfect example of visionary R&D, point 3, and massive market potential and scalability, point 1. I mean, think about it. From 2007 to 2023, the iPhone and that whole ecosystem of services just transformed Apple. Made it a, $3 trillion company?
Incredible numbers.
And look at their R&D spending. It went from around $780 million in '07 to over $29 billion by 2023. That's a relentless Fisher-style focus on reinvesting in the future, things like their own chips, Apple Silicon, health tech, AR. That's point 11 to standing out in its industry.
Okay, Apple makes sense. What about other types of companies?
Well, the sources also brought up Costco. Seems different, right? Not a tech company. But Costco is a fantastic example of Fisher's points on management integrity, point 14, and having a sound, customer-focused strategy driving worthwhile profit margins, point 5. Costco's famous for running on really thin operating margins, like 2.5% usually. That's the profit just from selling goods before interest and taxes.
Tiny margins.
Right. But they consistently give huge value back to customers with low prices, and that builds incredible loyalty and drives long-term growth. The co-founder, Jim Sinegal, famously said something like, "We'll turn down a higher profit if it means sacrificing customer trust." That's pure Fisher. Point 92, management openness.
That really speaks to culture driving value, even if it means less profit today. Powerful stuff. Okay, what about a company that screams R&D and just dominating its field?
For that, you have to look at NVIDIA. Textbook case of R&D-led growth, point 3 again, and industry dominance, hitting point 15, how the company stands out. Plus, management determination, point 2. NVIDIA spends, nearly 30% of its revenue on R&D? And they just own the market for the GPU hardware that powers almost all the AI development right now.
Yeah, their rise has been astronomical.
Absolutely. Market cap blew past $3 trillion in 2024, almost entirely driven by this AI boom. Fisher would have immediately seen their technological edge, their moat, and how they keep reinvesting, point 10, to stay ahead. And maybe one more quick one. Adobe. Their story is great for illustrating long-term strategic reinvestment, point 8, and that bold business transformation Fisher admired. Fits point 11, standing out, and point 13, long-range outlook. Remember back in 2012, they made that really gutsy move, shifting from selling boxed software to a cloud-based subscription model, SaaS.
Yeah, that was a big deal at the time. Yeah. Risky.
Very risky, but hugely successful. Their revenue shot up from around $4 billion then to over $19 billion by 2024. And they did it while keeping really healthy operating margins, like 30–35%. That's a company willing to shake things up for future growth. Classic Fisher thinking.
We could probably find Fisher principles in Amazon too, right? Customer obsession, long-term growth over immediate profits for years.
Oh, definitely. Amazon hits points 1, market potential, 4, superior sales, 8, reinvestment, and 13, long-term view. Bezos prioritizing growth for 2 decades, AWS becoming a massive profit engine, very Fisher.
And Netflix, disrupting themselves from DVDs to streaming.
Absolutely. Points 2, determination to grow, 3, R&D effectiveness, and 12, management openness about challenges like churn. Visionary R&D and management foresight were key.
Okay, so finding these great companies is one thing, but what does all this mean for managing your investments? Fisher had some pretty strong views on when to actually buy, and maybe even more critically, when or if to sell.
Oh, absolutely. His advice on buying was, well, profound in its simplicity. Buying right, not timing right. He really pushed back against trying to perfectly time the market or waiting for that ideal dip. His belief was, if a company truly meets your tough, long-term standards based on that deep scuttlebutt research and the 15 points, then you should just buy it.
Even if the price seems kind of high,
Yeah.
based on current earnings, say.
Yes.
Yeah.
Even then. His logic was that being patient and holding a truly high-quality business for years, letting it compound, will almost always beat trying to snag it a bit cheaper and risking missing out entirely. The long-term compounding power of greatness was the real prize.
That feels so counterintuitive, though, doesn't it? I mean,
Yeah.
every instinct tells you to lock in profits when a stock has run up a lot. What led him to this almost radical hold forever idea?
Well, he saw it happen again and again. Investors selling their best ideas way too early. They'd take a nice little gain, maybe double their money, but they'd miss out on the stock going up 10x, 50x, 100x over the long haul. Fisher thought selling too early was probably the single biggest mistake investors make. So he set incredibly strict rules for selling.
Okay, what were they?
Basically, you should only sell if the company itself fundamentally changes for the worse. If it stops meeting those key points from his framework, or obviously, if there's outright fraud or some major ethical disaster with management, or, and this is important, if you realize you made a mistake in your original analysis, you got it wrong.
But not just because the price went up.
Absolutely not. Never sell just because the price shot up fast. Never sell because the overall market looks scary or uncertain. Never sell just because you want to lock in gains on a great company that's still great. He famously said, if the job has been done correctly when a common stock is purchased, the time to sell it is almost never. He really meant it. Hold on unless the business itself breaks.
That brings us right back to something you mentioned earlier, the people, the management. Fisher seemed to place an almost unbelievable amount of weight on who was actually running the company.
He really did. For Fisher, the quality of management was, and I think this is a direct quote or close to it, more important than any balance sheet. He truly believed that. He looked for signs of great management, like clear long-term thinking, transparent communication telling shareholders the bad news as well as the good, a willingness to admit mistakes and fix them, not sweep them under the rug.
And passion.
Yes, and a real passion for innovation, for pushing the business forward constantly. He told investors, you need to actively study management. Read the annual letters carefully. Listen to earnings calls, not just for the numbers, but for the tone, the strategy. And watch how they act during tough times, during recessions or industry downturns. That's when you really see their character and competence, not just when everything's going great.
Right, crisis reveals character.
Exactly. And he warned against all the common pitfalls, too. You know, buying a stock just because it's popular or everyone else is buying it. Relying only on simple ratios like PE without understanding the context. Selling your winners to buy more of something mediocre just because it looks undervalued.
Chasing cheapness over quality.
Precisely. Or just trusting headlines instead of doing your own digging, your own deep work, as he might put it. Quality takes effort to uncover.
So, if we were to boil it all down for you, the listener, what are the absolute core lessons from Philip Fisher? It feels like a few key ideas really weave together here.
I think that's right. First, there's scuttlebutt research. Go beyond the numbers. Talk to people, dig for qualitative insights. That's your edge. Second, the 15 points framework. Use it as a rigorous filter to find businesses with genuine long-term potential, looking at management, R&D, strategy, culture. Third, buy for quality, not cheapness. A great business at a fair price is usually better than a fair business at a great price. Durable growth wins.
And hold on tight.
That's number 4. Patience is profitable. The real magic happens through long-term compounding. Don't get shaken out easily. Let your winners run. Fifth, great management is non-negotiable. Integrity, vision, execution, it all starts at the top. This is maybe the most critical factor. And finally, sell rarely and only on facts. Don't sell based on price action or market noise. Only sell if the fundamental quality of the business deteriorates or you made a clear error.
Wow, what an incredible framework. It's like if Benjamin Graham taught us defense, how to protect our capital, find safety, then Philip Fisher taught us offense. He showed us how to actually build wealth, not just preserve it, by identifying and sticking with these truly exceptional growing businesses.
Oh.
Hopefully this deep dive has given you a shortcut, not just to understanding Fisher, but to thinking about what makes any business truly great.
Absolutely. And maybe we can leave you with one final, really thought-provoking quote from Fisher himself. He said, "The stock market is filled with individuals who know the price of everything but the value of nothing. So I challenge you to think about that. What does value truly mean to you beyond just the price tag? Whether it's in investing or, frankly, in any area where you're trying to really understand something deeply, try applying that Fisher mindset. Go beyond the surface. Do your own scuttlebutt, whatever that looks like for you. Seek out the real underlying quality, the long term potential in whatever it is you're evaluating.